Imagine this, you bought a beautiful apartment in Paris. Every month your tenant pays the rent and France taxes that rental income. Then April comes, you sit down to prepare your US tax return, and suddenly you realize something terrifying. Wait, the IRS wants me to report the exact same rental income? For a few seconds, it feels like you're about to pay tax twice. And that is exactly where thousands of Americans living in France panic. But here is the good news. Article 6 of the French-US tax treaty was specifically designed to prevent that from happening. And there is one major change since 2019 that has made life dramatically better for Americans owning French real estate. Let's break it all down. First, we need to answer a very simple question. What exactly is considered real property under the treaty? Article 6 says that the definitions follows the law of the country where the property is located. So, if the property is located in France, French domestic law determines whether if it's real estate or not. That generally includes apartments, houses, buildings, lands, and all rights attached to immovable property under French law. Once we know that the property is considered French real estate, the next rule becomes incredibly simple. Rental income is taxable where the property is located. If your apartment is in France, France has the primary taxing right. It doesn't matter where you live. It doesn't matter whether your tenant is French or foreign. It doesn't matter whether the rent is paid into a French or an American bank account. The location of the property is what matters. So far so good, but then comes the famous American exception. As you probably already know, the United States is one of the very few countries in the world that taxes its citizens on their worldwide income. That means even if you are a US citizen that has lived in France for years, even if you are a French tax resident, and even if France already taxes your rental income, you still have to report that same rental income on your US tax return. And this is where many people think they are about to be taxed twice. Fortunately, that is not how the French-US tax treaty works. The treaty provides a tax credit mechanism. In practice, the tax paid in France can generate a foreign US tax credit that offsets the US taxes on the same rental income. The objective is simple, you should not pay twice on the same income. Now, here is something many people don't realize. In practice, French tax on rental income is higher than the US tax on rental income. Why? Because in France, rental income is often subject not only to income tax, but also to the French social contributions known as CSG and CRDS. These additional contributions can represent a significant cost, and for many years there was a frustrating problem. The IRS did not generally allow these French social contributions to generate a foreign tax credit. In other words, you paid them in France, but it didn't help to reduce your US tax. Then came a very important development. Since 2019, following a major change in the interpretation of the treaty, the United States generally recognizes the French CSG and CRDS paid on the French rental income as creditable foreign taxes. This is excellent news for American taxpayers in France because these social contributions can be substantial, and now they can be included in the tax credit calculation instead of becoming an unrecoverable cost. Now, let's talk about another tax issue that creates confusion every tax season. France offers different tax methods for taxing rental income. One of the most popular is the micro-foncier regime. Instead of deducting your actual expenses, France simply grants you a standard allowance. It's quick, it's simple, and for many landlords it is advantageous. But here is the important part. The United States does not recognize the French micro-foncier system. When preparing your US tax return, you cannot simply copy your French taxable income. Instead, you must calculate your rental income under the US tax rules. That generally means reporting the actual rental income and deducting the actual deductible expenses that would be recognized under US law. In other words, even if France uses a flat allowance, US return is prepared as the real expenses were actually calculated. Does that prevent you from claiming the foreign tax credit? Not at all. It simply changes the computation. The foreign tax credit mechanism still applies, only the calculation of taxable income follows different domestic rules. And that is an extremely important distinction. So if you remember only 3 things in this video, remember these. First, French real estate is generally taxed in France because that is where the property is located. Second, US citizens must still report that income to the IRS because the United States taxes worldwide income. And third, the foreign tax credit provided under the France-US tax treaty is designed to prevent double taxation, and since 2019, the inclusion of French CSG and CRDS in that credit has become one of the most valuable improvements for many taxpayers owning French real estate. Finally, if you would like to go deeper, I've placed several useful resources and official references in the comments below this video. If this video helped clarify one of the most misunderstood parts of the France-US tax treaty, don't forget to like, subscribe and share it with someone who owns property in France. It could save them from making an expensive mistake.